Hello, we are still in chapter 25, managerial accounting, short-term business decisions. We're gonna take outsourcing. Making outsourcing decisions. Fiber Systems manufactures an optical switch that it uses in its final product. The switch has the following manufacturing cost per unit. So we have direct materials, direct labor, variable overhead, and fixed overhead. So the total will be 24.5, which is the product cost. Now this is the cost of manufacturing, of making the switch. Another company has offered to sell Fiber Systems the switch for 18.5 per unit. If Fiber Systems buys the switch from the outside supplier, the manufacturing facilities that will be idled cannot be used for any other purpose. None of the fixed costs are avoidable, which means it's unavoidable. So the fixed cost here, he's saying it's gonna be unavoidable, so it's gonna be irrelevant. So I'm gonna pay it if I make the switch or if I outsource it. Prepare an outsourcing analysis to determine whether Fiber Systems should make or buy the switch. Now let's make outsourcing analysis. What's gonna be the cost if I make and what's gonna be the cost if I buy? This is exercise 2518. Okay, make or outsource or buy and keep facilities idled. So if I outsource, I'm not gonna use the facilities to make another product. Okay. Now, if I make, I'm gonna pay direct material, direct labor, and variable overhead. And I'm gonna also pay the fixed overhead, but I'm gonna pay it under both cases because he said it's gonna be what? Irrelevant. Irrelevant means there is no difference. Okay, so I'm gonna pay $9 if I make and if I buy. So you can ignore it. Direct materials is 9, direct labor is 1.5, and variable overhead is 5. Now if you buy from outside, you're gonna pay the purchase price, which is 18.5. So what's gonna be the total cost? If I make, I'm gonna pay 15.5, and if I'm gonna buy, I'm gonna pay 18.5. So which is better, to pay 18.5 or 15.5? The cheaper, it's 15.5. So the decision here will be to make the switch. Now exercise 2519, refer to exercise 2518. Fiber Systems needs 84,000 optical switches. By outsourcing them, Fiber Systems can use its idle facilities to manufacture another product that will contribute 253 to operating income. So this is a profit. If I outsource, I can use the facilities to make another product, and this product will generate profits of 253,000. Now, identify the expected net cost that Fiber System will incur to acquire 84,000 under 3 alternative plans. So now we have 3 alternative plans. which are what? To make, so this is exercise 25-19. We have three options: to make, or to outsource, to buy, and if I buy, I have two options: to keep facilities idle, or make another product, use the facilities to make another product. So let's see what's going to be the cost under these three alternatives. If I make, I'm going to pay direct materials, direct labor, and variable overhead and fixed overhead. Again, I'm going to pay fixed overhead under three cases, so no need to add it. Okay, 9, 1.5, and 5. Okay, this is per unit, so I need to multiply it with 84,000. Or I can just multiply 15.5 with 84,000. This is the net cost or the total cost. It's saying net cost because the last option I'm gonna subtract something, that's why it's net. Now the cost for the first option, it's gonna be 15.5 times 84,000, so it's gonna be 1,302,000. Now if I buy and keep facilities idle, I'm gonna pay the purchase price and the fixed overhead, but again I'm gonna ignore the fixed overhead because I'm gonna pay it in three cases. So I'm gonna pay 18.5 per unit, so I need to multiply it with 84,000 switches. So it's gonna be 1,554,000. And the last one, to buy and make another product, I'm gonna pay also the purchase price because I'm gonna outsource it, which is also 18.5 per unit multiplied by 84,000 switches. But here I'm gonna make another product and it's gonna contribute 253 to operating income. So we cannot add profit to cost. I need to subtract the profit of making the new product. So the product is 253,000. So I need to subtract this number from 1,554,000. So it's gonna be 1,301,000. So which is the best option? Again, this is cost, so you need to look for the cheaper, 1,302, 1,554, or 1,301. It's 1,301. So the decision here will be to buy the switch or to outsource it and make another product. Use the facilities to make another product. So the decision rule here to outsource: if the differential cost of making exceed the differential cost of outsourcing, I'm gonna go to the lower cost, so I'm gonna choose to outsource. If the differential cost of making are less than the differential cost of outsourcing, I'm gonna make. I'm not gonna outsource. Thank you for watching. If you have any question, please leave a comment. Please like, share, and subscribe.